Good evening, class, and welcome to our taxation class for today. Okay, we want to begin our lectures for today. Our lectures for today is on this topic here, taxation of special businesses. Taxation of specialized businesses. That is our focus for today, specialized businesses. So you will be asking yourself, what kind of business is a specialized business? We're going to see what constitutes a specialized business and how we go about finding the tax for such kind of business. Objective is for us to understand the peculiar tax laws relating to specialized businesses and to compute the taxes payable, including minimum tax. Okay? Now, in your syllabus, part of what is covered in this topic is tax provisions for real estate, agriculture, and so on. Now, for real estate, the taxes that are applicable are to property transactions in Nigeria are the following: companies income tax and personal income tax. So these two taxes are applicable to real estate. Any income or profit earned by a taxable person in respect of property transaction is liable to the payment of tax. So if a company is in a real estate business, that company is liable to pay the company income tax. For the benefit of the syllabus, which did not incorporate the Finance Act of 2019, we're going to say the tax rate is 30%. I think that is what we'll be using, except in the exam you stated otherwise. But we know that tax rate in Nigeria for small businesses is 20%, and the definition for a small company is a company that operates a revenue less than 25 million naira. So 24,999 is still a small business. It's a small company. You know, a company is any business concern that has LTD or PLC as its name. So anything that is a business concern that doesn't have LTD or PLC is not a company, but it could be a firm, it could be a partnership, it could be a body corporate, it could be a body corporate because it is registered, but it is not a company. So we are talking about company. And so when I say company, you know it's LTD, PLC. So they are going to pay 30% for the sake of this syllabus. And for individuals who are into real estate, their income is graduated from 7% down to 24%, depending on the income of the individual. Now, we also talk about withholding tax. You must have learned about withholding tax. The payer of any income is expected to withhold 10% when the recipient is a company. So when you are paying to a real estate and the real estate person collecting that money is a company, you have the right to withhold 10%. But if the person is an individual, then you take 5%. So you see 10% withholding tax on an individual, on a company, 5% on individual. What is withholding tax? Withholding tax is that part of your income tax that is taken early, that is taken from source very early, while you are waiting to file your remaining tax at the end of the year. So the amount deducted by the tax by the payer, who is the payer? The person who is paying the bills, should be remitted to the relevant tax authority within the period specified by law. In the exam, you might be asked, what is the period specified by law? The period specified by law is 21 days following the month where the duty to withhold the tax arises. But because of this coronavirus issue, it has been pushed to the end of the month. So that doesn't mean that 21st has changed. If everything goes back to normal, or if it is captured in the new finance bill, if they will do 2020 finance bill, then it's going to be a law. But for now, that is a provision. All right. When a withholding tax is being paid, they are going to be provided with what we call withholding tax credits. So this credit is used to reduce your tax liability. Tertiary education tax. What is tertiary education tax? Like any other tax, companies, you see the word I stress companies, not business name or enterprises. Companies that are into real estate are expected to pay the tertiary income tax in accordance to the law. Now let me even, and the tertiary income tax is 2% of the accessible profit of the company. Now let me bring your attention to the fact that even if a small business that is below 25 million is not expected to pay company income tax, which is 0%, zero rate, they are expected to still pay their education tax. So all companies, whether you are on 0 CIT, on 20% CIT, or 30% CIT, you are expected to pay your 2% accessible profits. Also, one thing about company income tax again, that if you pay within 3 months after the end of your year, after the end of your company's accounting year, that means you pay 90 days early, within 90 days early, because normally you are given 180 days, which is 6 months, to prepare and file your tax. If you can do that within 90 days, you are given 2% discount on what you are supposed to pay. If you are within the threshold of 25 million to 100 million. Then if you are a big company, you have 1% discount. I just thought I should say all of these for the sake of the exams. Now, value added tax is also one of those tax that is being paid by real estate company. Now, value added tax is you are supposed to register for VAT within 6 months of commencement of business with the relevant tax authority. Now, for those of you who are into maybe one day you may want to open your own business, because I do that for people. When you register your business, whether it is a business name or it is a company, it is mandatory that within 6 months you should go and get your TIN for VAT. You should go and get your TIN for VAT. Why? Because whether you are personal income tax, which you pay to Lagos State government or Abuja FCT or to the state you belong, VAT goes to the federal government of Nigeria. And so you will have your TIN, which is from federal government, and JTB will give you your TIN. They call it payer ID. For example, in Lagos State where I am, we have a payer ID. So for a company, you have your TIN, you have your payer ID. Your payer ID, if you're a business name, is for your tax that you pay to the state. But if you're a company, you will just have only TIN, no payer ID. That TIN is used for both your tax and for your withholding tax, for your VAT. Now, why will businesses who are not into limited get VAT? This is because even as a business name, it is possible that you are going to get up to 25 million as your revenue. And you know, it is based on revenue that you pay VAT. So when you get up to 25 million as your revenue, you will be liable to collect VAT. Even at that, if you don't even collect VAT, when you are suffering VAT, the company that is charging the VAT is supposed to know your VAT TIN, so that they will say, okay, they charge VAT on your behalf. So you see why you have to get your TIN for VAT, even if you don't use it. Okay, we now go to in VAT, the VAT rate now is 7.5%. So sometimes you may be selling something that is 100 naira, and as at January 31st, because you are putting VAT on it, it becomes 105 naira. As at February 1, it will become 107.5. That is because of the VAT, 7.5%. In the exam, please look out for the tax rates and use what is given to you in the exam. What is in the real life is real life. What is exam is exam. Exam is trying to test your ability, not testing where you can remember as it is. Because sometimes they will give you 5%, and because you think it is 7.5 and you now use 7.5, you will be failing small mark. Personal income tax comes into play when you sell a property or when you receive rent from rental properties that you own. These are earnings based on which you are expected to pay tax. And now the Lagos State, the percentage is dependent on the level of the income of the taxpayer, and it starts with 5% all the way to 20% for those who earn as much as 1 million naira per month. Land use charge. Land use charge is normally practiced in Lagos, and that's for properties. The land use charge is like ground rent that you pay annually by property owners in Lagos. So it's only Lagos that has this. So it may come up in ICANN, it may not come up because not everybody use land use charge. But since ICANN is based in Lagos here, and many people are Lagosian, don't be surprised if it comes. Now, there are also another tax that you can pay. So this generally is telling you all the taxes, although not all was put here because there is what they call capital gains tax. That is not for them. Then we have stamp duties. Stamp duties relates to documents that you bring for filing. For example, you want to open a company. If you want to open a company or a business name, you pay some fees. That fees is called filing fee. They will also charge you stamp duties. Stamp duties is 15 naira for every transaction that exceeds, that is from 10,000 naira and above. That is some stamp duties on some particular documents. There are some stamp duties that are fixed, and there are some that are ad valorem. The ad valorem is depending on the nature of the transaction, depending on the nature. So, for example, if you want to register a company, they will ask you, what is your shares, the authorized shares you want to use. The authorized shares will depend, will not tell them how much to charge you for filing. The duties for filing, the stamp duties involved. Now, look at your check that you issue out. You know, you pay for check, although they still charge you VAT, but you pay for check. That check is fixed amount that you pay for check. So the check you pay is a fixed charge because it does not depend on the value of what you write on that check. So the check you use in transferring 5,000 naira and what you use in transferring 5 million, you pay the same fixed rate. So there's what they call fixed charge, fixed duty, and there's what they call ad valorem. Now look at agriculture. Agricultural trade business is defined in the Act as any trade or business connected with the establishment or management of plantation for the production of rubber, oil, palm, coffee, tea, and similar crops. The cultivation or production of cereal crops, tubers, fruits of all kinds, cuttings, beans, granosiea nuts, bananas, vegetables, pineapples, bananas, plantain, all of that, even poultry, piggery, farming, fishery, all of them refers to agriculture. Now, the gain or profit from any land that is used for agriculture purposes or for livestock shall, unless the relevant authority satisfies to the contrary, be deemed to be gain or profit from which should be realized by the taxpayer if the land were dealt with, as the case may be, in a manner and up to average standard of cultivation. What they're saying is that you are still going to pay tax. So in all of these I just mentioned here, there are not going to be calculations. We are just going to be seeing what is applicable. So I want you to study this agriculture, what is agricultural business involves, what real estate business involves, what kind of tax is involved here. Now, if they want to test you properly on calculation on specialized business, what they will test you on is that of air transport and sea transport or communications. Now look at air and sea communications. You see here, the taxation of profits of specialized business are covered by the provisions of section 14 to 17 of Company Income Tax Act. I will advise you that if you are learning taxation, especially if you want to really practice, you go and get the tax law book. You go and get all these company income tax. You can also get them online so that you can be seeing them and really understand. Although they are written in the language of law, but once you are familiar with it, when you see it in textbooks being explained, you will understand. Now, which kind of businesses are covered here in specialized business? We have the foreign companies that are engaged in air, sea, transport. Foreign companies that are engaged in cable undertakings. Foreign companies engaged in insurance business. And Nigerian companies engaged in insurance business. Then companies engaged in authorized unit trust schemes. For the sake of your level, we will not be talking about the insurance business. This same topic will be discussed again in the professional level, where you will see the insurance business being discussed fully. We are going to be taking that of air and sea, cable undertakings. These are the main ones that you will be tested. Now take note, these are foreign companies. All the while we have been doing taxation of companies, all the while we've been doing taxation of companies and individuals or sole proprietors, we have been referring to Nigerian company. So can you give me an example of foreign companies engaged in air transport? Yes, we have British Airways. British Airways. Now, British Airways is a foreign airline company. A Nigerian airline company could be Arik Airline or Aero. So when Aero is doing their business, it is not covered under special businesses because all the profits from Aero contractors that they get worldwide, since they are Nigerian registered business, will come to Nigeria, it will be charged under CIT. CIT. So 30%, as the case may be, the worldwide income. But now British Airways could be having a registered office in Nigeria, but it is not a Nigerian company. I'll give you another example. Look at foreign companies engaged in cable undertaking, or let's say in communication business. We have MTN as a classic example. Glo is a Nigerian business, and so it is not under the foreign, it's not under the special business, because every income made worldwide will come to Nigeria. It will come to Nigeria and be taxed by Nigeria. So the provisions for that one is the double taxation provision, which you will learn in the advanced tax. But when you come to special business, you are looking at foreign companies, companies that were not incorporated by CAMA, companies that were incorporated elsewhere apart from Nigeria, but they now register that their incorporated business in Nigeria. They have a branch in Nigeria, they have a presence in Nigeria, they are doing business in Nigeria. But what happens when they make profit, which includes the profits made in Nigeria, they will repatriate it to their country. Just like MTN, they will repatriate all their profits back to South Africa. And so what happens to the profits made in Nigeria? That profit made in Nigeria will be taxed by Nigerians. That is one thing you should know. So let's look at the provisions, okay? Foreign companies engaged in air or sea transport business are accessible to tax in Nigeria in respect of their income that they got in Nigeria, which includes income derived from loading of passengers, mails, livestock, goods, which we call cargo, into aircraft or ship in Nigeria. Exempted are incomes of in respect of passengers, mails, livestock, or goods. A. Loaded on routes outside Nigeria but terminating in Nigeria. And also in transit in Nigeria, that is brought to Nigeria for transshipment or connected flights. Let me give you an example. All right. Let's say British Airways made a flight, maybe a 7 a.m. flight from Nigeria to London. From Nigeria to London. Now, what income is that? That is income derived from Nigeria because the people pay their tickets in Nigeria, they entered the plane in Nigeria. That was the originating point, the take-off point of their journey. So the income belongs to Nigeria. Now, what if British Airways, the return leg, somebody from Nigeria goes to London and now is coming back from London and terminating in Nigeria. Now, is terminating in Nigeria means that he didn't pay it in Nigeria. The income belonged to London. I'll give you an example of maybe that is not a special business, but just to highlight this purpose. You know all these yellow buses. If you're in Lagos, you know about yellow buses. Now, let's say you are coming from Obalende and you are going to K2. Now, when you finish loading, the income there is generated from Obalende, and so they settle the touts there. What do they call it? Agbero there. They settle them because that income belongs to that park. Now, if somebody is coming from K2 to Balende, even if it is a full load that they bring and they terminate at Obalende, the money does not belong to those touts because that is not where they loaded. So what I'm saying here is where you load, where you take off, where you were originating the journey from, where it starts, where that journey starts, that is what determines where the income is originated. Now, where it terminates does not matter. So if it terminates in Nigeria, it is not a Nigerian income. Okay? Then we also have transit. How will I explain transit now? Okay, let's say you are, let me use example of Chisco bus. Now you are leaving from Lagos and you are going to Abuja. Now because you are going to Abuja, you will now pass Benin and maybe something happened, you spend the night there, you were offloaded, spend the night there, and perhaps the bus was not good. And so everybody were dropped at Benin Chisco Park. Another Chisco bus now came from Benin and carried all of you down to your destination, Abuja. Now, because a second bus originated from Benin, that doesn't mean the income is coming from Benin. There will be no money paid because they are just in transit. in transit. So anything in transit, the income does not belong. So what I'm saying now is, if British Airways is carrying somebody from London and is going to Ghana, and they stop at Nigeria and later continue their journey from Nigeria to Ghana, that doesn't mean it is an income from Nigeria. It is British Airways, it is London income. So that's what it means, that origin, just look at where does this income originate. That's it. All right, computation and assessable profit liable to tax. Now, the determination of profit or loss derived by a company in respect of loading of passengers, blah, 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 as they wrote it, their mails, livestock in Nigeria. So you see, the origin is in Nigeria. The origin is in Nigeria, is done using two methods. Now, the first method is what is going to be tested well. The first method is called the adjusted profit and the depreciation ratio basis. I'm going to explain that for you. Now, this method is used where the FIRS is satisfied that the tax authority of the foreign country computes their tax, their assessable profit, in the same basis that the Nigeria computes their CIT. So their basis for computing CIT is not materially different from that computed by Nigeria. So how does Nigeria compute their CIT? How do they compute their assessable profit? Normally, they have what they call the gross income. Yes. Then there are allowable expenses that they allow. There are some disallowable expenses that they do not allow. So what they will do is they will check, do you compute your gross income the same way as we do? Do you compute allowable expenses the same way that we do? What of the way you compute your capital allowance? Is it the same? How do you relieve your losses? Are they the same? Are they materially different? If they are materially the same, that means they ratify it. They say, fine, this is what we want. We are satisfied. So method 1 will be used. So how do we apply method 1? The first thing to do is, okay, let me give you an example. Let's assume that Glo Nigeria, which is not a special business, is making profit from all its branches and from all its communications, or maybe Aero Contractor is making profit from all these flights and all that. Everything will come to Nigeria, right? It will compute gross income, which belongs to Nigeria. All the expenses, it will remove all the expenses from the gross income, the allowable expenses, to get accessible profits. It is that accessible profit that will be used. But in the case of foreign companies like MTN, who do not belong to Nigeria, or let me use British Airways because we'll still come to communications. So let me not be calling MTN. British Airways. What they will do is they will still do the same thing Nigeria does. But because we are Nigerians, we know they did business in Nigeria. We on our part will take their record, and we will also compare with the activities done in Nigeria. And so what will we do? All the income that was given out and called gross income, we call the gross income worldwide income. We call it worldwide income, or we call it global income. Now, when we know the global income of the company as a whole, we know that that global income will go to the foreign company. That is not our problem. Now, we will know the global expenses, global allowable expenses. By Nigerian standards, we know that these are allowable expenses. And because the foreign companies are doing the same basis of taxation we are doing, they are going to still have the same principle of global allowable income minus your global allowable expenses. What do you have? You have what they call global adjusted profits. Global adjusted profits. Normally, if it is Nigeria, we say gross income minus allowable expenses will give you adjusted profits. But now this is on a global scale. You are doing it globally. So it is called global adjusted income. But when you get that, there is something else you must do. You must look for what they call adjusted profit ratio. Adjusted profit ratio. So what is adjusted profit ratio? It is your global profit. That is your global adjusted profit divided by global income. Now that profit is the profit that you have before depreciation. So you must have added back your depreciation. So you have your global adjusted profit divided by your global income multiplied by 100. You have your adjusted profit ratio. So you do the same thing for depreciation. You have depreciation ratio will be your depreciation worldwide divided by your global income times 100%. That will give you your depreciation ratio. So what do you do with those two items? What do you do with those two items? Okay, look at what you will do. Now, after getting your adjusted profit ratio, you will now say that your worldwide income is 1 million. That is your worldwide global income is 1 million. Now, when you now adjust it, you now have adjusted global adjusted income. You have 800,000. So you mean that it is now 800,000. For you to get the adjusted profit ratio, is going to be 800,000 divided by 1 million times 100, which gives you 80%. What it is telling you is this, that your percent of your income, there's a difference between income, which is revenue, and your profit. The difference is expenses. The difference is expenses. So that means your expenses is rather 20%. So it means that your global profit is 20% of the global income, or the 80% of the global income. Now, that's what they call aspect ratio. For those of you who are doing picture cropping or television, you want to look, when they say aspect cropping, it means that if you say 2:1, it will maintain that 2:1 even though you are enlarging it. Let's say you snap a picture 5:7 and you want to still enlarge that picture and you want to maintain that aspect ratio. You will find out that as you are increasing the size, the length, it will be following the same width so that that ratio will be the same. What do I mean by bringing that? It means that if you have an 80% profit, which is your adjusted profit to your income worldwide, that will also go across board. It means that Nigerian income should be, okay, Nigerian profits should be 80% of Nigerian income. That would mean that Ghana profit will be 80% of Ghana income. So if the worldwide income is 80% of the global income, it should maintain that ratio when it comes to Nigeria. So that means Nigerian profit or Nigerian total profit or adjusted profit, if you want to call it, should be 80%. Now let's say Nigerian income happens to be 100,000 out of the 1 million, 100,000. That would mean that 80%, which is 80,000, is Nigerian profits. The same thing with depreciation. If your depreciation worldwide is 200,000, that would mean that it is 20%. Maintaining that same ratio, if Nigerian income is 100,000, depreciation must be 20% of it. So it's going to be 20,000. So you see the taxable income, the ratio of the taxable income is maintained. That is what we are saying. Now look at the pro forma. We have what we call the Nigerian income, which is income receivable in Nigeria. Then we have our assessable profits, which is the Nigerian income multiplied by the APR, which is adjusted profit ratio. Note here that we are not interested in the expenses. We are not interested in the expenses. Yes, let me tell you why now. It means that, how did we get our profits? We must have deducted expenses, isn't it? So if your worldwide income is 1 million and your worldwide profit is 800,000, it means that your expenses was 200,000. That means your expenses was 20%. It's not of interest to us because we don't use expenses to do anything. But what we now look at it is that the worldwide income is 1 million, adjusted global profit is 800. The profit is what we are looking at. So we are looking at the profits in relation to the income. So we ignore expenses. The only way we are taking cognizance of expenses is when we want to check which one of them is allowable and which one is not allowable, so that we can disallow the ones that have been allowed wrongly. But when we do that, we are doing it to compute our adjusted profits. Now you see Nigeria income, the assessable profit multiplied is what your profit will have been if you have taken into cognizance Nigerian expense, which we have ignored. Then we look at capital allowance, which is depreciation in lieu of capital allowance. When we less it, we have our total profit. Now, it is under CIT. So you know that you are going to charge 30% of your profit in airline. You're going to charge 30%. But you also have to note that there is what we call minimum tax. What is minimum tax? Minimum tax in this situation means 2% of the income. 2% of Nigerian income. 2% of Nigerian income. Now let's look at an example to highlight what I mean here. Exercise SB is for special business, SB01, okay. The profit and loss account of a foreign airline. So once The moment you see something, it tells you it's a special business. Now, when you now see airline, not only are you seeing foreign, you are seeing these keywords, foreign airline. Just underline and say special business. That's fine. Ethiopian Airways Limited for the year ended 31st March 2003. You know that it is preceding year basis. So what will be the tax year? The tax year will be 2004. Now, look at all of these. Forgive me, the line did not come up. There was supposed to be a line here. When you add 300 to 220 to 180 to 500, you are getting 1,200,000. Now, when you add 800 to 120, that is 920, plus 40, that's 960. This is the 960. You now less it. This is your profit for the year. Now, can you see something here? Do you see that other disallowable expenses, 40,000, are included in this figure that was deducted? That means they have done something wrong. Now, it means that the use of the word other disallowable expense means that there are not only one disallowable expense, there are more than one. So which one do you think is a disallowable expense? The other one, you find it in depreciation. You always disallow depreciation. Then it is possible that inside here, salaries is allowed. Perhaps these other expenses, you might find other disallowable expenses. So these are sensible ways you are looking at the question to see what you can do. That's one thing you note. Now, from the body of the question, this is an income, this is an income, this is an income, this is an income. When you total them together, this should be your gross income worldwide. So this 1,200,000 is your worldwide income. Note that. So these are the things you may be doing with pencil as you get your question and you are interested in this. I want all my students to be interested in special business question because every time they bring it, you are going to get almost the whole mark. Now that you've known it is your Nigerian income, and I told you the principle is originating. Now, they said income from passengers freight into coming to Nigeria. So this 300 is not a Nigerian income. So what you do, you use a pencil and mark it bad by the side. You come here again, income from goods loaded into aircraft in Nigeria. Don't be fooled by this into because it doesn't work the same thing with this into. So you look at this, what is before Nigeria is what you are going to be looking at. This is into Nigeria, it means coming to Nigeria. This one is in Nigeria. That means they load these goods in Nigeria. So you take this one good. This is a Nigerian income. Now come here again and say income from passengers loaded and flown out of Nigeria. That means it must have originated in Nigeria. That means 180 is a Nigerian income. Then we'll come here, income from goods loaded into aircraft on other routes. This is not a Nigerian income. So you mark this bad. So we have identified two incomes that are Nigerian income. We have that of 220 and that of 380. What would that give you? 400. So 400 naira, 400,000 is Nigerian income. So out of 1,200,000, 400,000 is Nigerian income. Now that you've done this preliminary things, you have not read this required, because why you have to know is special business. You start thinking about what are the things that they will be telling me about special business. I need to know Nigerian income. I need to know worldwide income, because I will likely be doing the depreciation ratio. I will be likely doing adjustment ratio for profit, which of these things are allowable and disallowable. So the additional information, does it contain information about disallowable expenses? That's number one. Will the FIROS be satisfied with the way that Ethiopian country, this country, is carrying out their tax assessment? That is what will make you know whether you're going to use method one. Go to required or additional information. You are giving the following additional information. One, the Federal Inland Revenue, underline this word, is satisfied. You underline it, that the tax authority in Ethiopia computes the assessment tax on similar basis with Nigeria. That's one. That is fine. And has received certification of the appropriate ratios. What are those appropriate ratios? The appropriate ratio simply means the adjusted profit ratio and the depreciation ratios. So when they are satisfied with the way that you carry out your tax assessment, they are going to certify your ratio. So that is what they are telling you. They are certifying the adjusted profit ratio and the depreciation ratio. Now that you've known that, they now said the tax authority has agreed that depreciation charged in the account, which is 120, can be granted in lieu of capital allowance. What they are telling you is that what you see here as depreciation, normally you have disallowed it here, take it as your capital allowance. We are telling you that we have agreed that you can take your depreciation in place of capital allowance. So if they say we do not take it in lieu of capital allowance, they will give you a capital allowance figure. So in special businesses, one thing that you must not fail to see is depreciation. You will never fail to see depreciation in the question. Never. Because you need depreciation ratio. Now, if they don't give you depreciation, they will give you capital allowance. Okay? Then, the third thing now is salaries and other expense include, wow, we know that salaries is an allowable expense, and we are saying that we are suspecting these other expenses. So let's see whether the things they are mentioning, whether they are disallowable. They said deposit for a new VC-10 aircraft, 80,000 naira. This aircraft is not an operational expense. It's a capital expenditure, and so it should not be under expenses. It should not be expensed but capitalized. So this 80,000 naira is going to be disallowed from this figure. Now they said payment of 24,000 naira to Nigerian Port Authority for the use of the VP lounge at the new Murtala Mohammed Airport by the airline's first class passengers. It is disallowed. Then we come again, payment of 12,000 naira as rent for accommodation used as transit flight by the airline's crew. So if transit income does not belong to Nigeria, why would the transit expenditure, even if it is accommodation, rent, why should it belong to Nigeria? So this word transit has spoiled the whole thing. It is not allowed. Now, I want you to note something in taxation. If they tell you salary and other expenses, now look at the word, they said include. When they say include, they are going to be telling you figures that you must adjust. Anything they give you here is not allowed. Now, if you look at it now, this plus this plus this does not give you 800,000. So they just tell you that they want you to disallow this, they want you to disallow this, they want you to disallow this. Now, that is if they use the word include. Now, if they tell you salary and other expenses comprise of, you have to be very, very careful. They are going to give you everything that make up this 800,000. Everything they will tell you there will be what makes up this 800,000. It is you who will use your judgment to look at those expenses that they break down. Some of them are not allowed. That is why they are breaking it down for you. So you have to use your sense to know which one is allowed and which is not allowed. So pray that they will always be bringing include and not comprise. If they give you include, take all of them. Most likely, all of them are not allowed. But if they give you comprise, you have to now use your sense to know which one is allowed and which is not allowed. Now, required. Compute the total profit for Nigerian tax purpose. Now, look at it here now. This is an airline company. So you're now supposed to look for total profit in Nigeria. And what they gave you here, this expenses, depreciation and others are not Nigeria, they are worldwide. So how do you compute Nigerian total profit? That is why we need those ratios that we explained. Let me go to the solution on page 6 here. Okay. All right, so this is the question. Now let's go to the solution. You see, solution in part A says total profit for Nigerian tax purpose for 2004 tax year. So because it is ending March 31st, 2003. So now let's see. What we now did was we have to do our adjusted profit. How do we do our adjusted profit? We start with our net profit. When you start net profit and you walk up, because there are two ways to do this. There are two ways to do this. The first way is to start from net profit and walk up to get your adjusted global profit. The second way is to start from your gross income and go down to get your adjusted global profit. I will do the two for you and I will tell you which one of them you should use on which occasion. Now we started this first one. I want to start from down up. We have 240 for the net profit that you've computed. No problem. They say no wahala. Look at this 240. Now, it means that before you got this 240, there are some things you must have deducted that are not allowed. Since they're not allowed, we add them back. So we say add disallowable expenses because they're not supposed to be deducted. They have already been deducted. So you are adding them back because they are not supposed to be deducted. And so the first one we are doing is this man here, depreciation. You see, they deducted, depreciation is part of this 960 they deducted. So we are adding it back. We have our depreciation, 120. Then all of these expenses we saw here in salaries and salaries and other expenses, which includes what this 80,000, this 24,000, and this 12,000. We are going to add them back. See me adding them back. Then what again are we adding back? I think that's all. When you, okay, there's what they call other disallowable expense. They mentioned it. Other disallowable expense, 40,000. You add it back. So when you do your adding, your 240 plus all of these things added back, you are having 516,000. This is your global adjusted profit. So this is what you are getting as a profit that has been adjusted. It has been adjusted from 240 down here. This is supposed to be for your financial reporting. Doesn't concern them. But for tax, this is what we are using for tax. This is what you are showing in your financial report, which is fine. But for tax purpose, it's not fine. This is what tax is based on. Now, we call it global adjusted profits. So there's another way we can get this 516. Let's do it again. So follow me closely. You may not see my calculator. Let me bring out my calculator. You may not see it, but if you see it, fine. I'm trying to get my calculator. If you see my calculator, fine. If you cannot see it, fine. All right? Let me assume you are seeing it. We have assumed that, okay, we are not assuming. This is 300,000 income, 220, 180, and 500. We said your gross income is 1,200,000. So I will start with 1,200,000. Now, I am going to less allowable expense. You see, when we are starting from net profit, we add disallowable expense. If you are starting from gross profit, you are lessing allowable expense. And so what are my allowable expense? The only thing I will do here, I will not touch this 400, this 40, I will not touch this 120. Then I will look at 800. What I will do is minus, open a bracket, 800,000 is what was here, but I'm going to remove all of these. 800 minus 80 minus 24 minus 12. It's as good as saying using 684. Instead of saying 800 minus all this, you would have done it separately and say 1,200,000 minus 684. When I press equal to, I'm having the same 516. 516 is my global adjusted profit. So that is it, global adjusted profit. Now the next thing to do is to look for your ratios. So you first of all look at the steps. Get your global adjusted profit first. Then you note your global income. There is no way you can get your global adjusted profit without knowing your global income. So know your global income, get your global adjusted profit, then start doing your adjusted profit ratio. This is the formula. Global adjusted profit multiplied by 100 divided by global income. So now look at your adjusted profit ratio. It is the adjusted profit, which is 516, all over your 1,200,000 worldwide income multiplied by 100. You are getting 43%. What it means is that this 516 is 43% of your income. So that means your allowable expenses happens to be like 57%. That's fine. So this is your adjusted profit. The next thing to do is to do your depreciation ratio. You come again and say your global, sorry, it's supposed to be global depreciation. Sorry, copy and paste. I forgot to remove the depreciation. It's global depreciation. So you take a pencil or biro to cancel it. Global depreciation divided by global income. So what is your global depreciation from the question? And they told you that the question says that the tax authority has agreed that the depreciation charged can be granted in lieu of capital allowance. So that's why we are using it. Your depreciation is 120. So you say 120 over 1.2 million times 100 will give you 10%. So these two ratios are important. Now that we've finished the worldwide scale, we've gotten our worldwide income, we've gotten our global adjusted profit, we have now gotten our adjusted profit ratio, which we will now use locally, and your depreciation ratio, which we will now use locally. It is time now for us to go and get our Nigerian income. So we are narrowing it down now to Nigerian profit. Now, I told you before that Nigerian income consists of income from goods into aircraft in Nigeria. Remember, 220, and income from passengers loaded and flown out of Nigeria. So these two constitute Nigerian income. When you add them, total Nigerian income is 400. So what do you do? If your profits, adjusted profit for worldwide is 43, maintain the same ratio. That means that your Nigerian profit must be 43% of Nigerian income, 400. So Nigerian adjusted profit must be 43% of Nigerian income. So you have it there as 172. Then you say if depreciation is 10% of the global income, that means depreciation or capital allowance, as I wrote here, will be 10% of Nigerian income. That's what we have here. So when you less profit, your total profit from, so this adjusted profit, you less this depreciation from it, you are having 132,000 as your Nigerian total profit. So this is what they're asking you to calculate, Nigerian total profit. So easy. The steps again: 1, get your global worldwide income or global income. Adjust it so that you get global adjusted profit. When you get your global adjusted profit and your global income, look for the ratios. Adjusted profit ratio. It has to be global adjusted profit divided by worldwide or global income times 100. Then you also look for the second ratio, depreciation ratio, which is total depreciation divided by your worldwide income times 100. Once you're done with the ratio, it's time to apply them locally. How do you apply them locally? Go again to where you derive your worldwide income. Look for Nigerian income and bring it out. Get the total of Nigerian income. Then apply the ratios. That would mean that Nigerian adjusted profit will be 43% of your Nigerian income. That would be your adjusted profit for Nigeria. Then you come again. If your worldwide depreciation ratio is 10%, apply it locally. 10% of 400,000 is going to give you your capital allowance for Nigeria. Less of capital allowance for adjusted profit, what you have is your Nigerian total profit. Simple as ABC. The next question, it says here that compute the income tax payable by the airline for assessment year 2004. So what is the income tax? This is the simplest of it. You will come again and say income payable to tax will be 30% of your Nigerian total profit, which is 39,000. You're not going to compare with your minimum tax. Minimum tax is supposed to be 2% of your Nigerian income, not adjusted profit to Nigerian income. 2% of this. So this is the minimum. So you check the higher of the two is what you are going to choose as your tax payable. But notice here that they will not pay education tax. They will not pay education tax. Ask me why. I'm hearing someone asking me why. This is because education tax is chargeable to all companies incorporated in Nigeria. It's for all Nigerian companies. So foreign companies do not pay education tax. They do not pay education tax. So don't go and compute education tax in special business. Special business, no, education tax does not exist. If it exists, if you put it in your answer, you have shown the examiner that you lack understanding of what education tax is. So don't put it. They don't pay education tax. So these are the two tax you are asking them to pay. Either you pay the CIT Sorry for the the interruption, the break in transmission. Let me share my notes again. I'm so sorry. Excuse me. Okay. One moment. All right. Now we are told to calculate the income tax payable for the year, which we have calculated. And we now said that method 2 is used when they are not satisfied with the criteria used for computing assessable profit and to determine tax. They are not satisfied how they compute assessable profits. Fine. The FIROS will now use their discretionary power to determine profit derived from Nigeria. So what will they do? They will apply a fair percentage on the income that is tagged Nigerian income. So all they will do is they will find the global income. They will not even be concerned about the global income. They will take Nigerian income. And what they will just do, they will just say, let's use a particular percentage. They would have determined the percentage in advance. It's a fair percentage. They will say, okay, let's say 20% or 30%, or maybe by experience, they say 40%. They can say 40% will be what is accessible profit. So that is how they are going to do it. So they're not going to be using uh, method 1 process that you have to compute adjusted profit ratio, then you now compute depreciation ratio. They are going to use their discretionary power to do that. So now look at what they will do. They will say, look at your Nigerian income, then look at your accessible profits. They will now use a fair percentage to get it. But what will happen is that, other point you need to note is that when method 2 is used, the foreign company shall be entitled to require that its assessments be revised and recomputed on the basis of method 1. So they may not be agreeing with that fair percentage that the government is using. They might say, I have the right to make a case that you use method 1 to handle my situation. This request will be valid only if the company make it within 6 years after the end of the relevant assessment year to which it relates. All right? So you have seen that. Now that we've seen method 1 and method 2, in the exam, mostly you'll be tested on method 1. Method 1 will be your major point. But it is good is engaged education. Now, this is almost the CN falls into this. The MTN, they do not use to, let's say telecommunication, foreign telecommunication belong to this. Which profits are we going to be seeing as profits derived in Nigeria? Let me give an example. If you make a call from Lagos to Abuja, of course, you know it belongs to Nigeria. If you make a call from calling London, if you call London, it belongs to Nigeria. Okay? If you buy a recharge card and scratch it in Nigeria and load it in Nigeria, and you decide to go and call from London because you roam your phone, you now call from London to Nigeria. Who has it? Is it Nigeria or London? It's London. Now it doesn't depend on where you scratch the card. Where you scratch the card, you've bought the card, they have charged you, they have taken their income. When you are now expensing it, who is charging you for the call? It's London. So it is not where you buy the card. It is where you make the call. If you make the call from Nigeria, it's Nigerian income. If you make it outside Nigeria, it's not a Nigerian income. Now, also in the way of transit, if the thing pass through Nigeria in transit, it is not Nigerian income. All right, so that's the way we look at it now. Look at this other example. Sorry for the way these things are being scattered. When you type something and arrange it well, by the time you convert, they are scattering. Sorry. Even once I put underlines, they just scatter. Sorry, I'm going to tell you how to arrange it. Ultimate Limited is a Canadian, you have heard of Canadian foreign company. You know, it's special business. And what really make it special business? Engaged in cable undertakings. You note it is a foreign company, special business in Nigeria. Give me 1 minute. Let me plug my phone, or my system. All right, I'm back. Thanks for waiting. Now you've seen that cable undertaking is mentioned here, and it's a foreign business. It's a special business. They said it's worldwide management. You're not noting that they're going to give you worldwide accounts. For the management account for the year ended 30th September 2002, you know preceding year would be 2003, reveals the following. So these two naira sign with thousands are here and here. Cable, okay, income from cable messages. Now the word is terminating in Nigeria. So terminating is ending in Nigeria. It is not Nigerian income because it is terminating or ending in Nigeria. Now, income from cable messages routed through Nigeria, it is not, it is in transit. Now this one, income from cable messages, the operating word is originating in Nigeria. It's a Nigerian income. So you look at terminating is not, routed is not, originating is. So when you add 200 plus 150 plus 100, you have 450. So your worldwide income is 450,000. Your Nigerian income is 100,000. Now, look at less salaries and wages. Of course, salaries and wages should be allowable. Depreciation, 90,000 is not allowable. You know that. I said they will give you. Now, overhead expenses, you have to be very careful if this 85,000 will contain disallowable. Purchase of equipment, disallowable, because equipment is not an operating expense. Equipment is an asset which should be capitalized. So when you are purchasing assets, it's not an operating. So this 39,000 is disallowed. Now, when you add from 180 down to 39, you have 394. When you less your 394 from 450, you're having 56 as your net profit. Now look at the notes. Then I said the FROS is satisfied. You should be looking for that word, that the tax computed and assessed in Canada is the same basis with Nigeria. So when you see is satisfied, it's a nod for you to say method 1 is to be used. This is telling you the method to be used. Now, the Canadian Tax Authority has certified the adjusted profit and depreciation allowance ratio. So if they have certified it, and the FROS is saying that they are competing and they are satisfied with the way they are competing, it also means the FROS will certify it. So that means what they are saying is that the adjusted ratios and depreciation ratio that is used for worldwide should be applied to Nigeria. Now I said be careful of overhead expenses included. Now look at that word, not comprise. I say be praying for word included. Included in the overhead expenses are disallowable items totaling 23 million. They just told you disallowable items. If they have listed all the things and they didn't put the word disallowable, just know that all of them are going to be disallowed. I say when you see the word including or included and they give you parts of it, know that those parts are disallowed. But when you hear comprise, look out for the allowed. Now they said compute the company's adjusted profits. So how do we get the adjusted profits? The adjusted profit here, let's go down. Which page is that? It's page 9. So here is page 6. Let me go to page 9. Adjusted profits. Okay. Solution. How do we get the adjusted profits? We start with our net profits and we add back the disallowable. One of them is depreciation. The second one is the disallowed expenses. We said 23 million. The third one is that purchase of equipment, 39 million. You add these three things together, it gives you 152,000. You add it back with this 56,000 and your global adjusted profit is 208. Now, mind you, this is your global income. We said everything totaling together, which is 450, is your global income. So what were we told to find? In our A part, we are told to find the adjusted profit, the company's adjusted profit. Look at the company's adjusted profit here, 208,000. That's the adjusted profit. Now, what is the second one says? Determine the adjusted ratio, profit ratio, and depreciation ratio. That is the next thing to do naturally. So you see here, you need to know your worldwide income. You need to know your adjusted global income. So you adjusted up here, your worldwide down here, multiply by 100, you have 46.22. For depreciation, you need to know your 90 million divided by 450. That's what we did here. 20% is our depreciation ratio. When you do that, that's the answer to that question. The third one is compute the total profits and income tax payable in Nigeria. So now this is where we are applying it to Nigeria. So what do we do for income tax in Nigeria? We will have to bring our Nigerian income and profit. So this is our Nigerian income. This is the only thing giving us income in Nigeria, which I say is 100,000. You underline it double. Then you come and say Nigerian adjusted profit. You have to bring adjusted profit ratio. multiplied by this Nigerian income. That will give you 46,220. Note that this 100,000, you will double underline it too, so that it will not affect. I did, but I don't know how it happened here. Less capital allowance. Capital allowance is a depreciation ratio 20% multiplied by your Nigerian income. You have 20,000. So when you say 46,220 minus 20,000, your Nigerian profit is 26,200. Now look at the income tax payable for Nigeria. You come and say your income tax payable is 30% of your total profit, which is this. Then your minimum tax is 2% of your Nigerian income, which is this. You underline double, choose the higher of the two. This is the higher. That's it. So I believe that with these two questions, you are able to see how we do special businesses. Special businesses are those foreign businesses that operate in Nigeria. Now, look at taxation of authorized unit or trust scheme. It says a unit trust scheme is an arrangement whereby facilities are provided for the participation of the public as beneficiary under a trust in profits or income arising from the acquisition, holding, management, or disposal of securities or any other profit whatsoever. Now, the taxation of unit trusts. They said ordinarily, trust income is assessable on the beneficiaries of the trusts after deducting trust expenses and fixed annuities as may be provided for by the deeds or in the trustee, in his or her name as a trustee. However, Section 17 of SITA makes special provision for the taxation of the profit of an authorized unit trust scheme. Now look at what it says. It says here that you have to put investment income that is from unit trust investment. So when it comes to unit trust, it's a different thing from just ordinary trust. This is the amount less management expenses, including manager's remuneration. This is your accessible profit on it. Then what do? That is where we charge our tax. Now there is what we call turnover tax. Turnover tax is the federal government is through the FIRS has the discretionary power to access and charge a company to tax on a fair and reasonable percent of the turnover of the trade of the business. The FIRS is entitled to exercise in any of these circumstances where it appears for a relevant year of assessment, the business has either no accessible profit. So when you have no accessible profit, they can say tax turnover on tax. Accessible profit in which the FIRS think is lower in their than what might be expected, is lower than what is expected, they will use turnover. Or that the true amount of the accessible profits cannot be readily ascertained. The implication of the above is that whatever is obtained by applying a fair and reasonable percent as may be determined by FIRS is deemed to be the accessible profit for that year. It means that if they cannot determine your accessible profit, maybe you have no accessible profit, they cannot determine it, they will just say, okay, let's go to your turnover and just apply a fair percent on your turnover. This is as good as using method 2 in airline and shipping and airline and in communication. It's as good as using method 2. They go to your turnover or your income. But you know, for Nigerian companies, this section has been abolished. You don't charge tax on the turnover of the company. So if they don't have any accessible profit, you take it that way. Now there's what they call small company relief. Small company relief has also been taken over. They say this applies to a company with a turnover of 1 million or less. All right. This small company relief has been taken over by the Finance Act. Small companies now do not qualify. Anyone that qualifies at 1 million is still a small company. But in this definition, before now, once you have over 1 million of turnover, you are a medium or a big company. You're a big company. Then small companies. But now, a small company is 25 million or less than 25 million. Once you've entered 25 million, you are a medium company. So this does not apply. So I will not talk about it. I'd like you to read it. Then I'll also like you to read taxation of enterprises in free trade zone. Take your time and look at it. Now you see there are some other provisions of the Nigeria Information Technology Development Agency Act. Now this includes the information tax, ICT, they call it IT tax, which is at an applicable rate of 1% of profit before tax by some specified companies that are over 100 million. So you see, who is a company that is, once you are having 25 million and above, up to 100 million, you are in the medium scale. But once you have entered 100 million and above, then you are in the big industry. Now they specify these industries. If you are a cyber company or internet provider, you are a GSM service provider and all telecommunication, you are a pension manager, you are banks, you are an insurance company, you qualify for all these and you pay your IT tax. So you see, the bank pays company income tax. If you're a Nigerian bank, you pay company income tax, you pay education tax, you now pay IT tax. The same thing with MTN, the same thing with Glo. I mean, MTN does not pay medication tax. For Glo, you pay education tax, pay company income tax, pay IT tax. So that's it. So penalty for non-compliance attracts 2% of the tax payable. Now there is one tax that is, I don't know whether it is operational in Nigeria. I don't know how compliant it is. They call it police trust fund. It's supposed to be 0.05% of profits, of net profit. Or is it profit before tax? I don't know how applicable it is. I didn't hear about it in the Finance Act. So I will not say much about that. So you've learned of IT tax, you've learned stamp duties and all other tax. So IT tax is 1% of profit before tax. So it is not accessible profit. All you need to do, you go and that your net profit that you are checking. That net profit is your profit before tax. That is what you are going to use as your profit, what you are going to compute your 1% on. So in summary, what have we learned today? This topic has helped us to understand the peculiar laws relating to special businesses in Nigeria. So we have seen special businesses in Nigeria. We looked at, first of all, we looked at the real estate businesses. We looked at the agricultural businesses. Then we went on to look at the sea and airline company. Then we went to look at the cable undertaking, the communication company. Then we jumped now to look at unit trust scheme. Don't confuse it with estate trust and settlement. You know, there are trusts there, there are trusts here. So when it is unit trust, you follow this one. Then we now talked about the last one we talked about here is the companies that are liable to ICT tax, IT tax. There is one we did not talk about, and I said it is not for your syllabus. I checked again today, it's not for your syllabus. It is insurance. Insurance company. If you look at it here, it is stated here, insurance company. Insurance company has their own peculiar calculation, which is long, and it is not for your level. Even the level that it is for, I have not seen ICANN setting questions on that. So this topic, learn this topic well, because you shall meet it again in your professional. And so when you are meeting it, then it's going to sound like revision to you. So any questions so far before we call it a day? Any question? I'm open for questions now. Okay, I see that there are no questions. So if there are no questions, I will let you go, because there are some people who are here that wants to do FRO to join the next class. So if you have any question, feel free to send it to the WhatsApp group. Let's have our continuation of discussion in the WhatsApp class and talk more about this particular topic and any other topic that you may have difficulty understanding. I wish you a nice day as we prepare for the next class that you will be having on Thursday with Adesua. Then later on Friday, we will be having another session. Perhaps this week or next week, we may complete the syllabus for taxation. So you have more time to now read. Thank you so much for having me in this class. I'm sorry for all the inconveniences that network would have caused. So once again, I want to say stay safe and be good. Bye.